Sampling practice exam. Oops, didn't do all that like I should have. There we go. Okay, let's go ahead and get started, I guess. Okay. So planning the the audit, client acceptance. The first one we have to see is so this is when you have a potential client. Actually, this is any client, but especially for a new client, the question comes up: are we qualified to do the audit? So can the audit be completed? Now, the rules for this are that you um, can accept a client in a type of business that they have never audited before. If, oops, if, let me do something here. Let's see what I'm writing. If they believe that they can they can become familiar enough to complete the audit. So even if you have not audited that type of business before, if you believe that you can get the information and you can get the information, it could be from um, could be you can get information online, could be from another auditor, professional. Oops. These are all things you can do to get yourself up to speed. And if you think about it, so you can't accept an audit from type of business that you haven't audited before if you can become competent enough, basically, to complete the audit. It could be online reading. It could be another auditor, bring another auditor that's already done it, in, whatever. However you want to get up to speed. Now, if you think about it, uh, the it'd be kind of silly to know how to audit something that you haven't audited yet. You for instance, like let's say it's a hair salon. I've never audited a hair salon. It'd be silly for me to learn how to audit an hair salon if I don't have any clients that have hair salons. Right. So it isn't that that you can't do it. It's just that to make sure that you can get up to speed. And okay, yeah, I think I can get up to speed on hair salon. Okay, they do a service, they cut hair, and then they also sell stuff, and it's inventory or whatever. So even though you don't have expertise, you can still do it as long as you uh, rightfully believe, let's say, that you can get up to speed as far as doing it. So, and again, it would be silly to learn how to audit something that you don't have any clients, an industry that you don't have any clients in. So it's not that unusual. And everybody has to start somewhere if you get a new client. I gotta move something here. Okay. Legal and ethical requirements. Legal requirements. Well, let's do the ethical ones first. Independence, Chapter 3. All those millions of rules. Immediate family and close relatives and friends and all that kind of stuff. So you got to make sure that you have that. And actually, most of this is Chapter 3 stuff. Other clients that might be in the same business that you are, maybe they're going to have lawsuits against each other, stuff like that. I'm not going to put all this stuff in there, all this stuff, but basically the same stuff as we have in Chapter 3. Lawsuits, and if you're suing the client, you can't take it and all that kind of stuff. Okay, this is the one that is very important, even though it doesn't look like it should be, but it is. It's the most important factor for accepting them as a client. And this is one of those weird things that's very different for auditing, or well, being a CPA basically, than other ones. And again, it doesn't look like it's that big a deal, but and this is one thing that a lot of times people who are looking for an audit will sometimes wonder why. But the integrity and reputation of the client is the most important thing. The only thing that we give to the financial statements is credibility. And because of that, we cannot be associating with people who lack integrity or have bad reputations as far as business is concerned, because it will reduce the credibility that we lend to the financial statements. And it uh, isn't just for us, isn't just for the CPAs will use it. You gotta remember you have other clients. And so if you're doing work for known, people who are known criminals and things like that, it reduces what you're actually giving to your clients, because the credibility will be such that, okay, well, this is signed off by somebody who's has a connection with them. And this is very different from other fields. If you look at professionals like doctors, they're required to help people as much as they can. And lawyers, same thing, they're supposed to give their client, whoever it is, the best legal help that they can, regardless of what kind of a person they are. Somebody accused of murder or something like that, you have to do your best. Now you get somebody accused of murder and they want to get an audit of their firm or something, of their company, you very well may not be able to take that because of the reputation. So the integrity, it isn't like McDonald's or everyone that walks in, we don't care what you do. Yeah, you want a Big Mac, whatever. Yeah, okay, here we go. It's not like that. And it's a profession, but you can't do that. And so the ASCPA they'll tell you that you cannot be associated with those kind of people because the credibility goes away. And the only reason we're here is for credibility. So, okay. The successor auditor contacts the predecessor auditor prior to acceptance. Okay, first thing to know is what's the successor? The successor is the new auditor. And you can probably guess what the predecessor is. That's the old auditor. And I say if one exists because if this is the first audit, they may not have one. You know, if they've never been audited before, they're not going to have an old auditor. Oh, one more thing on this. I can probably tuck it in somewhere here. I'll put it right underneath here. You must get the client must approve the predecessor auditor talking to contacting. I'll clean this up in a second. Okay, let me highlight that. So the client must approve the successor auditor contacting the prior, the old auditors before they take the audit. And the reason is because of the fiduciary duty. The old auditor, the predecessor, still has the fiduciary duty. You know, not to give information to about the client. Okay, so what do you think happens if the client doesn't do that? The client doesn't allow you to talk to the old auditor. So you say you have to talk to the old auditor, and the client says, "No, I'm not going to do that. You can't talk to him." Anyone? Throw a guess out. Well, you generally don't take them because that's what they call a scope limitation. If they don't allow you to talk to them, it's a scope limitation. So a scope limitation is that um, you're not allowed to see something, and they may have a reason for it. Oh, those guys are jerks, and look, if we have to pay them more money, we'll pay them more money, but you still can't take it, and you can't take it because again, it's a scope limitation that you can't contact them. It's information you need, and that they're not going to allow you to get it. And you can tell them, look, okay, they very well might be, maybe they are jerks, okay, but we still need to talk to them before we can take the audit. So um, you have to be able to contact the predecessor. There's unusual circumstances where maybe you can't. Maybe the predecessor auditor died or left the country or did something, whatever. But if they are available, you need to be able to contact them. Okay, so where do you find information on them, and what do you talk to them about? Well, one of the things that they have for publicly traded company is an 8K report, which I'll talk about later. Yeah, we'll talk about that in a little bit. But basically, you're going to look at the big thing, integrity of management, reason why they felt that there was a change, why they changed auditors. Could be because they want, it could be the auditor's idea, disagreements. You'll notice that they're not really asking about the audit itself. They're asking more about the people. This is what you're actually talking about is you're not going to ask them about how did you audit cash. You're going to ask them about the people that are involved in the company. Okay, shopping for accounting principles. It's on the CPA exam sometimes. Shopping for, accounting principles is when there's a disagreement with an auditor, and they said, okay, well, you're not the only CPA firm. They start calling around saying, could you be our auditor to somebody, another CPA firm? And they said, by the way, this is how we're accounting for our revenue. Do you agree with that? And if they do, then they become the new auditor. So the AICPA says warns against people shopping around for. You know, yeah. And client continuance is what it means. Do you continue with the same with your clients? And basically, if you have a client that's by the book and all that, you're probably okay. But if you got a client that's a nightmare, you may want to just not deal with it. And by the way, you want to tell them as soon as possible after the audit, so that they can get another auditor. Okay. Questions. A. Attempts to communicate between the successor and predecessor should be initiated by the which one? You guys already got these? Anyone? Well, let's go down to eight to a D, eight, the 8C. This the SE 8K report. The SEC 8K. The SEC 8K is actually a report this it's not just for auditors, it's for many different things. Whenever you have a change in management, a change, you have a merger, or anything that's actually of significance that happens in a company, you will file an 8K. But one of them is if they change auditors. So what is in the 8K? In the 8K, we have the two audit firms. We do not have the reason for the change. We don't have the fee amount. We do look at the significant disagreements over not 5 years, but 3 years. and the predecessor's response to the significant disagreements. And basically, all the disagreements, the client reports the disagreements to the SEC, oops, and the SEC asks the predecessor auditor if the reported disagreements are complete. And it's a yes, no answer. And if it's yes, everything's okay. If it's no, it goes back to the client and the SEC says you have to tell us more. So this is kind of the SEC's way of getting all the information about what happened, any problems that they may have for it. So the predecessor auditor will say yes or no to, this is all the agreements or it's not, and it'll be yes or no. Okay, I need more room. Okay, which ones of these are we going to look at? Which of the following is important when obtaining new clients? How about A? You guys already got this? All right, let's go on. Establishing an understanding with the client. Engagement letter basically has audit agreements and expectations, and it's basically on both sides. It's basically the auditor saying we will do an audit for you, and the client basically within that engagement letter they'll say you have to provide us with the financial statements, all the information we need, and blah blah blah. So it's basically an agreement between the two parties of what they're going to do. Some audit books will say it's a unilateral agreement. It's actually not. It's bilateral because the client actually has to provide anything that they need, anything the auditors need. Okay, so that's the need for a specialist. The one that always is there is the pensions. Oops. You always have pension. If they have a pension plan, pension actuaries will always be there. IT people, you might have IT people to do the audit software. And use of internal auditors. This is quite heavily used. And it's heavily used often because the internal auditors have a lot more time to spend on things, and um, they're generally more objective than the rest of the people in the company, and that they have to look at things objectively and write the reports objectively and all that kind of stuff. So if you can rely on the internal auditors, you do. And when I was at Navistar and at US Steel, they relied pretty heavily on us. Time, stuff you can do and the end of the year is always a real rush time. Actually, right about now is when the audit firms will start ramping up because they'll start getting stuff done for they can start getting stuff done for like for the clients that have year ends at December, and a lot of the retail stores actually have their year ends on in January. Most companies have their year ends when after their busy season, if they have a busy season. So a lot of times the December sales for the holidays, and then even into January, they often get a bunch of a bunch of more sales. So you almost all the retailers will have end of January year ends. Other companies a lot of times will stick with a calendar year end, and those two tend to bunch up, and so you have this really compressed time between, say, November and April to get all this stuff done, and even before April, maybe more like March. Um, and that kind of coincides too with the tax season. That's why, I mean, during this time of the year, if you're in a CPA firm, you're going to be audited. You're going to be, just run crazy for weeks on end. And then in the summer, you have nothing to do. But that's just the business. Okay, first year. If a client has never been audited before, it could be difficult to actually give them a clean audit report because of some of the data in the financial statements. So here's our income statement. And I'm going to focus on the inventory stuff. Of the inventory stuff, which one of those numbers would be at year end would be the hardest to verify if they've never been audited before? So there was no audit last year. The spacing weird on this one. Anyone?
Beginning inventory.
Yep. Inventory. Oops. Yeah, because we can't jump in time and go back to the beginning inventory. So this one is one of those ones that is difficult to prove. Now, if they could were planning ahead, they can call you in and have you just do an audit of the inventory if they're planning on getting an audit next year. But if they really don't, if no one audited the inventory, then this one is possible that you could have a problem with it. And I think, yeah, and notice that the beginning inventory isn't correct. Or if you don't know, if this is unknown, that means this is unknown, and that means this is unknown. And if that's unknown, then the rest of this is unknown too. So it could be that there's a problem with it at year end to get the beginning inventory. Now, here is the kind of kicker thing that we should think about, and that is that there's actually some options here. Before I told you about that, they could get a disclaimer, the opinion. So when it comes to the opinion, if you run into this situation, it could be a few options. Let's see. Try that again. Okay, first thing you give them a disclaimer. So you could give them a disclaimer opinion. That's basically a shrug saying that you don't know. You'd rather not give that to them. You could also give them, do you remember what else? If you're not, if it's just one account, if they're off by? You could also give them a qualified. So if you're giving one opinion, you could give either of those two. A disclaimer of qualified. There actually is another choice, though. You can give an opinion on each statement. I don't think I talked about this. So our statements are statement of equity or retained earnings. Depending on who it is. We have the balance sheet. And we have the statement of cash flows. Yeah. Okay. You can actually give an opinion on each of those separately. And, it's possible you'd end up with something like this. You have a disclaimer. On the income statement. And you might give a unmodified or a clean opinion. Oh, wait a minute. On that one. I did this wrong. Give me 1 second. A statement of retained earnings has income on it. So these will get disclaimers. But the balance sheet might get an unqualified or unmodified clean opinion. Notice the beginning inventory. Inventory is on the balance sheet, but the ending inventory, we can audit that. We can look at the ending inventory. So it is possible that you also split up the opinion, that you get a disclaimer on the income statement, income goes into the retained earnings, they'll get a disclaimer. Cash flow starts with net income, so that'll get a disclaimer. But the balance sheet, and notice that this is also giving something more to the client, and that they can say, yeah, well, they don't know about but all the stuff on the balance sheet is okay. The assets are okay, the cash is okay, the inventory is okay, the machinery is okay, the liabilities are okay. They can go to the bank with that and say, look, yeah, they couldn't do the time machine wasn't working, they couldn't go do the beginning inventory, but here's the balance sheet, and everything on this balance sheet is on, or fairly presented. So, and you're doing that because you want to help the client as much as you can. You're not going to do anything obviously crooked, but if you can verify everything on the balance sheet, give them a clean opinion on it, at least that is something better than a full disclaimer for everything. If you give them this on the whole thing, it's like handing them nothing. Here's nothing, here's our bill. Now, the second year, you'll have the ending balances on the balance sheet will become the beginning. Next year, this will be up here. That'll be the beginning balance, so you won't have a problem. Okay. Audit plan. The audit plan is a detailed high-level description of the nature, timing, and extent of risk assessment procedures. We'll talk about audit procedures and other procedures. A tentative plan is developed based on the auditor's initial risk assessment, and they may require frequent modifications. Okay, so you make this plan out. You make it out to a high level, telling who does what, how you do it, how you're going to audit it. And by the way, if you're worried about when you start auditing, gee, I don't know all this stuff, and really nobody does when they first start auditing. But they have audit plans, and if you it's kind of like baking a cake. If you follow the directions correctly, you're going to end up with a cake. And it's the same thing. It's verify that this matches these, and all this kind of stuff. And as you go through and you do the testing and you do the test controls and the sampling and all that kind of stuff, that's laid out for you in that audit program. And you don't make those up from scratch generally. And even if it's a new client, you're probably going to bring one of these from that the business had in the past, or even if you're making it on your own, you can go on the internet and find audit plans, say for auditing cash or inventory, whatever. And you're probably gonna have to adapt them. Every company is different, so they're all gonna get different audit plans. But anyway, it lays out how you do it. So I don't think that you have to know all this stuff when you start. You'll actually have it. And if you work for a place that already has done auditing, one of the nice things you look at last year, okay, if we already did the audit of IBM last year, well, let's see what they did last year. Okay, they gave me accounts receivable. I'm going to go look and see what they did for accounts receivable last year for IBM. What I'm doing is probably going to be fairly similar to what happened last year. Okay, and so these will change as time goes on. You find new risks, you find things that you thought were risky that aren't. You'll make changes. Okay, so they're highly detailed, the nature, timing, and extent that we're going to do these. And they'll change if the risk assessment changes. Certainly, we will look into it. But also, just as things change during the audit, you may want to look at certain things, and there might be things you thought were a problem that aren't going to be. Okay. So the audit plan, is it general in nature? Is it one size fits all? No. It's a detailed list of audit procedures. Can be changed and probably will be changed. I never was on an audit that didn't have something get changed. Sometimes for the good, sometimes for the not so good. Is based on risk assessment. Yes, you focus on those things that could go wrong. You don't just focus on everything. Same for all clients? Never. Every client is different. I know I say this all the time, so I'm probably boring you to death, but the my favorite fortune cookie we ever got was I think my son got, I can't remember, but it said there's no such thing as an ordinary cat. Everyone's different. Every company is different. Yeah, Walmart and Target are in the same industry, but they're completely different. And just because people are trying to decide between, well, should I invest in Target or Walmart or whatever, they're a completely different company. Maybe changed for a revised risk assessment, yes. Sometimes you say, oh man, there's a problem here. We gotta go look at it. Sometimes you think there's a problem, you say there's nothing here. Sorry, my phone that I can't turn off. Actually, I can turn it off, but it goes into the I have to do the airport mode where it basically bricks the phone, so so nothing can happen. Okay, so what could go wrong? Whenever we talk about risk, we're talking about two different things they go together, and that is the dollar amount and the probability. And suppose we come out with these risks. The question is, oops. Which one of these are we more concerned with?
B.
Yep, very good. Very good. Yeah, so this first one, there's a 1% chance. We can do multiply it out. 60,000. Now, 60,000, it might be a significant amount, but there's only a 1% chance it's going to happen. So this is actually a very low risk compared to the dollar, the dollar amount here. 800,000 times. Okay, I need my phone. Don't ring. Don't ring again. Yeah. 800 times 35%, 280,000. That's not right. Need one more zero. And we'll do this one just for fun. What is that, 2,800? Okay, so this one is probably, would probably be the one that we wanted to look at. A, the, probability times the amount is much higher, and 35%, that's like what, about 1 in 3. So there is a pretty good chance that that could happen. This one, the chance is pretty remote. Yeah, it's a big dollar amount, but it's very odd that it would happen. This one, while it could be off, and probably is off, the dollar amount, if you have a $6 million account or risk of, obviously something off by 2,800 probably is not material. Just in general, 2,800 compared to 6 million of anything is probably not that important, even if there's a high probability is off. So this might be something like petty cash. Uh, I want to say that whenever I've audited petty cash, it's always been off by something. And you're wondering, why did we audit petty cash? By definition, petty cash is petty. It's not material. But when I was in internal auditing, we would audit it, and it was always off by $5, $10, some weird number. So there was sometimes that there was more, and then that happened. One of the craziest ones though was when I worked at the engine. I was doing the audit of the Melrose Park engine factory. I don't even know if that's still open. It might. I don't know if that's open anymore. But anyway, in Melrose Park, Illinois, they used to have a engine plant, and they had a petty cash fund that had $10,000 in it, and they would replenish it sometimes several times a week. They did a lot of research, and a lot of this people would send this stuff, and it'd be sent COD, and if you didn't pay for it, they would just turn around and drive it back. So they'd have this pretty, a lot in there. And when I audited them, um, they were right on. There was no problem with it. And they had obviously, because they had so much money in it, they had more controls. But that was kind of a strange petty cash that actually was was for the amount of money we're going through it. It certainly was material. I don't know if the external auditors knew that. Okay, account procedures are the procedures. How to test risks above? You generally do that through your testing of controls and substantive testing, the dollars. You don't have to do the test of controls, but if you want to rely on them, you will. Public trade companies, they will do test of controls because they have to write it on they have to do an internal audit report. An audit controls report. Scratch that. Internal controls report. And other procedures are just some of the other stuff that is, for instance, the management letter corroborates information you have, the lawyer letter corroborates information. These are things that are standard that you do that you aren't necessarily relying on for the information, but you're using it as corroboratory evidence. Okay. Let's see here. Assessing what it risks, understanding the client and its business environment. All right. I'm going to add something here. I know I should have done this before I printed this thing out, but here we go. This is understanding of internal control. And this is understanding the client, but you also get understanding their internal controls. And basically, they're required to get an understanding of the internal controls. Now, if they're going to rely on the internal controls, they must do tests of controls. Okay, so they're required to get an understanding of internal controls. If they're going to rely on internal controls, they must do additional testing of internal controls. So everyone has to get an understanding of it. That's not optional. What is optional is relying on the internal controls. So if you're going to rely on them, then you have to do additional testing. If you're not going to rely on them, you don't have to do the additional testing. Okay, so when you're going through, a lot of the stuff you need to understand with the client, inquiries of the management, analytical procedures, observation, a lot of these things you're looking at are internal controls, how they do things, how they make sure things show up on the financial statements and all that kind of stuff. Let's get through that. Let's go to analytical procedures. I need more room. Analytical procedures. These are required. They're required twice. They're required once at the beginning of the audit. And they're required again at the end of the audit. So analytical procedures, these are actually a pretty big thing. Let me change this. Hey, I didn't capitalize audit on the second one here. Yeah, doesn't matter yet. You have to do it two different places at the beginning and the end. Now, you're wondering, well, what are these and why do we have to do this at the beginning and the end of the audit? And they're required. You have to do these. This isn't an optional thing. What we're doing is looking for plausible relationships between data. Could be ratios, could be other things, but you're looking at data and saying, okay, what would make sense if you're running a normal business, of these relationships between the data. And probably the easiest way to do that is look at this. We get 22 and 21. Hey, that's when I was born. All right. So what's unusual about this relationship between 2021 and 2022, like during the pandemic? What's strange about these numbers? the sales increased, right? And do something here.
Their return on assets was a lot lower, uh, considering they spent more on advertising.
Yeah. You look at this and you go, okay, well, wait a minute. Okay, how do you get more sales? Well, generally you have to do something. So, this increased, sales increased. I don't know where to put this. I'll put it over here, I guess. So sales increased. Um, and advertising expense decreased. That's usually not the way it goes. Usually if you want to sell more things, you will have, you advertise more to sell more. Or if you're paying commissions, you're going to pay more commissions, right? If they sell more things. So it's unusual that usually the sales expense and the advertising expense go up together or down together. So when you have this, it's, the plausible relationship is that they would be if one increased, the other would increase. Increase advertising, you increase your sales. Okay, so what are analytical procedures used for? Analytical procedures are used for um, they indicate where to look. Oops, for potential problems. So what we use these for is to say, okay, there might be a problem here. How come this, this doesn't make sense, is not plausible. And so we will look at it, they'll tell us where to look for the problems. Now, is this evidence of fraud? You get a client that gives you this, you're gonna call the police on them. Is this proof that they are doing something fraudulent? No. It could just be that, hey, maybe they advertise more effectively or whatever, or maybe they figured out that the advertising doesn't work or whatever, and they decide to cut the price and they sell more things. Whatever it is, it's not. So analytical procedures do not necessarily indicate, and usually they don't indicate actual fraud or anything, but they tell you where to look. They said, okay, this is odd. Go look at this, see what's happening. Maybe it's okay, maybe, but this is where to start. This is where to look. The usual thing about this, about the above information we already talked about. Um, Sales increased while advertising expense clean this up. So sales increased while advertising expense decreased. That's not what we usually expect. Again, Either the more the sales, the more the advertising, or the more you pay commissions or whatever it is. Okay, so what's the risk that must be investigated? Well, you actually got two things that might be going on here. It could be that these advertising expenses are wrong. It could also be that the sales are wrong, right? I mean, those are the two things that could be happening. Maybe this really isn't supposed to be 22 million, maybe it's supposed to be 18 million or something like that. That you'd expect if the advertising expense went down, that maybe the sales would probably go down. It could also be that the advertising expense is understated. So what are the two problems we did investigate? Advertising expense. Scratch it. Let's do sales first. Sales are overstated. Or that advertising expense is understated. Okay, so now I want to go back to so we're going to check to see maybe they have too much in the sales. We'll also check to see if they have too little in the advertising expense. Okay, so here you're wondering, okay, why are these required? Why are they required? Why, what is it? Something like 95+% of fraud is found through analytical procedures. They are extremely important when it comes to identifying, and this is why they're required. That 95% of the fraud cases found come from analytical procedures. Some say 99%, whatever it is. It's a very high number. And so that's why analytical procedures are required for every audit. Okay, let's stop here. Oof, not stoop. Let's stop. Hey, and let's take a break. Okay, let's say be back. Let's say 7:10. Okay. Okay, I think we'll stop here on this one. We'll come back to this next week. I want to get started on the sampling practice exam, and also take any questions you guys have on the Chapter 5 exam. I put more CPA questions on that one. If you have any questions on it, I can't tell you directly what the answers are, but we can go through and discuss what maybe they are. So if there's any of those you want to stick around for, I can talk about those too. But let's look at the auditing sample exam. We'll go through a couple of these. This first one is probably the one that's missed the most. And I know, well, it's probably because we only did one of them, I think. So good idea to do another one, at least, so that we can kind of get. And I think I know why it's a little bit more trickier, and that is because the upper limit is given is a percentage. It's not, they're not dollars. We're accountants. We used to read the dollars. So the idea of it being as a percentage is maybe a little bit not what we're used to. But anyway, so this is for tested controls. And again, these are, if you want to rely on the internal controls of a company, of your client, bold this. You need to do this testing. If you're not going to rely on the controls, you don't. Okay. Still. All right, so every other corporation says that a department manager must sign all purchase orders. So this is what we're looking, this is the control we're looking for. We want all the purchase orders to be signed by managers. Auditor took a sample of 300 orders. The auditor allows for an error rate of 7%. Okay, we'll leave that for now. Oh, wait a minute, I can put that on the second line, right? Sure I can. Oh, look at this. We can color coordinate all of them. And the allowance for sampling risk is 3%. That is so pretty. Okay. The following are the results. Okay, so what is the error rate? You want to have it? I remember how I set this up when I did it before. So we had 15 errors out of a sample of 300. It's 5%, isn't it? Hmm. Yep. So our error rate is this. Hmm. 0.05 or 5%. Now, this is our best estimate of what the error rate is. Oops, that's not how you spell best. So this is our best estimate as far as what the actual error rate is. It's 5%, but this is a sample, so it could be worse. And that's where this allowance for sampling risk comes in. To find the upper limit, we're going to take oops, our upper limit, we do, equals our error rate plus our allowance for sampling risk. Uh, I gotta wasted a little too much space down here, I think. Okay. So our error rate is 5%. Oops, plus allowance for sampling risk is 3%. So the upper limit is 8%. Or is it? Yeah, there it is. Okay, so again, this is a sample, so our upper limit is 8%. The auditor allows for an error rate of up to 7%. So can they rely on the controls? Anyone? Okay, so auditor, sorry. No, 7%. And the upper limit we have is percent. From our sample is 8%. So no, we cannot rely on it. It's less than our amount that we'll allow for. That's not me barking, that's my dog. That's actually the nice one that's barking. I don't know why the nice one's barking. All right, what's a misstatement of purchases? Don't know. There is no, there's no dollar amounts. So this would be unknown. It very well could be that there aren't any. Just because there is a problem with internal control does not necessarily mean that there's a material misstatement or any misstatement. Can you see my dog? He's upstairs. He looks like a gargoyle. He's a I should bring him down. He loves people. He was a shelter dog. He was a a rescue dog. But whatever they did to him, it didn't dull his enthusiasm for people because he loves everybody. Although now he's barking at someone, so. All right. Testing controls are required by ASC. Are they required for AACPA non-users? No. Well, actually, they're required if the auditors are relying on them. Let me write that in. Substantive testing. And substantive testing is like that's our classical sampling. Monetary unit. Too many T's. In one of our classes, one of the teachers I teach with, they, they actually had two students that brought in uh, the comfort dog, comfort animals. They had two of them. Wait, what did I just do here? And everyone's like, I want dogs in my class. But in Illinois, I didn't realize there's like a whole group of there's law like on what you can and can't ask people about comfort animal. That you basically it's you can't deny them. But that's why when you see a store they'll say no pets. Whatever service center, customer, and whatever animals welcome. Well, that's what actually to comply with Illinois law. It's actually you can't ask them basically why they have them, which I think is great. I'd love to see dogs, walking around. All right, or cats. Yeah, right. So let's do. Yeah, we can probably knock classical sampling out in a few minutes. We'll do this one. This one won't take long. And then I think we'll hold off on the monetary unit. This is a pain. We'll wait until next week to do that. Whenever you have something that's hard, put it off as long as you possibly can. Okay, so client has following information. This is the accounts receivable book value and the number of accounts receivable, and this is our sample. Okay, so we got to get and by the way, the CPA exam, this is the most calculations they'll have. Sometimes they'll just give it to you what the average is. but they might make you calculate it. If they do, this is how you do it. $50. All right, so the audit value is 50. The book value, what the client gave us, is what, 48? When I was in college, I had a teacher that used to bring a dog in sometimes. It was very different times. He was the head of the English department at Western Illinois University, and he, he would smoke cigarettes throughout he would just keep smoking cigarettes in class, and he'd go to the window and flick them out, and you say, "Oh, that's terrible." It was even worse than that because right below us was like where people walked in, so the cigarettes would come flying out, and it's kind of funny because later on, we walk by and the cigarettes would come flying out. We go, "Oh, I forgot his name, Doctor What's he's teaching, flinging cigarettes out the window." Okay, my guess is they don't do that anymore. So this is the average audit. This is the average. Oops. Okay. And so now we're gonna protect them. Mean per unit, just what it says. Mean is just the average, and we're gonna take our average, not the and I encourage you to kind of get used to just the terminology telling you what to do with it. You don't need to memorize the formulas, I don't think, on these for the most part. But once you get used to using them. Mean per unit average, so audit average is 50. Number of units, number of accounts receivables, 8,000. So we're saying every accounts receivable should be our same $50. So this will be our projected value. Audit average is 50 times, quick, I forgot, 8,000 accounts receivable. That 400,000. Better calculate. Yep. So this is our projected value. I'm just going to stick it right in up there. We don't like, we need to do all that stuff down here. So the projected value is 400,000. So this is what we think it should be. They're saying it's 380. I'm just going to put that here somewhere. So the projected misstatement is how much? Oh, you guys know this. 20,000. Oops. Overstated or understated?
Under.
Yes, understated. We saying it's gonna be 400,000. They're saying it is 380. So they're understating their accounts receivable. And it might be because they're trying to avoid taxes. It could be any number. It could just be an error too. It could also be that our sample does not match the population as a whole. If we're auditing like the 95% level, that means 5% chance that what we came up with is not actually what does not represent the sample as a whole. Okay, ratio estimation. Audit over book. You could actually take these if you wanted to. I'm gonna take the averages, but you'll notice that these are the same ratio. They divide with, as those. So, but I'm gonna say audit average divided by audit book. Oops. Okay, average is 48. So what we're saying in this one is that everything's off by the same ratio. In other words, large accounts will be off by large amounts, small accounts will be off by small amounts. Okay, oh, not equal. Take that out. That's the evil mark at work. The book value of the total book value is 380. And this will give us a projected value. So we're saying everything's off by the same ratio. 395, 833. 395, 833. I think that's it. So this is a projected value. Let's put a dollar sign in front of that. And so what is that misstated by? 19. 19,000, wait. No, 15,833. And again, that's understated. We're saying it should be 395. They're saying it's 380. So that's also understated. And the last was difference estimation. This is one that gets missed the most out of these. Oh, not too many people miss it, but if anyone does miss it, this is usually the one that does it. And that is, so we're going to subtract these. It's weird because it takes out the you find the projected misstatement first. So we take the audit average minus the book average, and we end up with a difference. Hence the term difference estimation. The difference is $2, positive $2. So what we're saying is that every single item should have an extra $2 added onto it. It should be the same as ours. So, if they have 40, so we're saying that every single item is misstated by $2, and it's an understated. They're understating their amounts by $2. So we will take it and multiply it by the 8,000 accounts receivable. We're saying every single thing, and it didn't get multiplied. Every single thing in there should have an extra $2 added to it. 16,000. So this one's wacky in that, so this is actually the projected misstatement. And it too is an understatement. And so you got to get kind of back into the projected value. So the projected, if it's understated by 16,000 and there's 380 in there, what is that? 396. I'll put the calcs in there for that. So this is 380,000 plus 16,000 understated. Okay, we'll actually do really well on that one. Let's stop here. I mean, yeah, almost always if there's an error, it's almost like a math error, if anything, usually. Okay. Any questions on the chapter 5 exam? Any of them that are perplexing? No? Anyone want to go over anything on the chapter 5? And even if you turned it in, if you have any questions on it, we can. You can always until I put a grade on it, you can turn it in. What happened here? Oh, there it is. He hates to be picked up. You know what? Maybe I get it. I'll give you guys extra credit. All right, I'll bring the dog. I'll bring the dog down. He'll be thrilled. Actually, I know what I'll do. I'll bring the little one. I have a little the female one. I'll bring her down, and then the other one will come because he's a nut. I'll get him. Hold on. Okay. So this is Polly. Hey, Polly. Like, so this is Polly. She's you wouldn't know it, but she's actually the one that runs the place. And you want to come up here, Charlie? Come on. You want? Still here a bit, Charlie. No? Okay, good.
Your dog's so cute.
Here. And he hates to be picked up. So this is Charlie. We call him Gargi because he looks like a gargoyle. Hey, look at the camera. Look at the camera. So yeah, well, what's funny is, he when they fight, he opens his mouth up, "Rawr," and then she sticks her head in his mouth, and then he comes over and tells on her. Isn't that right? You tell on her. So anyway, oh geez, don't fall on her. Okay.
Are you gonna dress your dogs up for Halloween?
I don't know. I haven't thought about it, but yeah. So this is Polly, and she sticks her nose right in his mouth, and then he starts gagging, and then he comes over and tells me that, tells on her. Say hi, pal. She's not used to being held like this. All right, it's okay. It's okay. I should dress them up like pumpkins, But anyway, all right. Well, I'm gonna put her back on. All right, you're freaking out.
Thank you.
All right, I'll see you guys next week.
Have a good one.
Thank you.
Good night,
Bye.
Professor.
Good night.